Before my upcoming guest episode on indexing and active management, I wanted to lay some groundwork. This explainer covers what the research says about the systemic risks of passive investing, including inflated valuations, concentration risk, and what happens when fundamental analysis disappears. Watch this first and you'll get a lot more out of the upcoming conversation. Sources are listed in the description below.
Welcome to Expanding Frontiers from Pearl Quest. I'm Catherine Wilkins. Here, we explore the evolving edge of investing, data, and the frameworks that help us make sense of it.
Let's jump right in. When most of us hear ETF, we picture a super simple, totally automated way to just park our cash and ride the broader market, right? But underneath that incredibly smooth, glossy surface, there is a massive, complex, and constantly moving plumbing system. In this explainer, we're taking a wrench to those hidden gears. We're going to zero in on the VIPs of this system, authorized participants, and we'll uncover the incredibly unique, kind of wild vulnerabilities that pop up when we introduce extreme, leveraged ETFs into the mix. Which leads us straight to a pretty huge question. Is passive investing actually passive? We're all taught that passive investing just means buying a tiny slice of the whole market, kicking back, and relaxing. But actually, scratch that, it's not that simple at all. For your index fund to feel passive to you, there is a literal army of institutional players sprinting at high speeds behind the scenes. They're constantly fixing prices and pumping liquidity. It is a highly active, frantic process, purposely designed to look like a perfectly calm pond to the rest of us. And the sheer scale of this is mind-blowing. We are talking about trillions of dollars, literally trillions, fleeing active equity funds and blindly pouring into passive funds over the last decade or so. Since 2009, the massive, relentless climb of cash into passive equity perfectly mirrors the money draining straight out of actively managed ones. In fact, active U.S. equity funds have bled cash every single year since 2006. This is not just a passing fad, you guys. This is a fundamental rewiring of how global money moves. Just to put that sheer volume into perspective, in 2019 alone, an absolutely staggering $163 billion flowed blindly into passive funds. Meanwhile, active funds hemorrhaged over $200 billion that very same year. When mountains of cash move like that, landing in funds that buy stocks based purely on their index weight, completely ignoring whether the underlying company is actually a good value, it completely distorts how the market operates. So here is our roadmap for today. We'll kick things off with the incredible passive boom. Then we're going to meet the mechanics themselves, authorized participants. After that, we'll dig into the liquidity mismatch trap, the real dangers of overcrowded trades, the wild world of leveraged and inverse ETFs, and finally, what all of this means for broader financial stability. All right, let's start with that massive passive boom we were just talking about, specifically the absolute explosion of these index funds. The shiny surface of the market today has become incredibly top-heavy. Think about it. Just 6 major tech giants are currently gobbling up nearly a quarter of the entire S&P 500. So when an index fund gets an influx of cash, it has to allocate that money based on those current weights, completely blind to the actual price tag or fundamental value of the companies. That means a huge chunk of your money automatically gets funneled straight into behemoths like Microsoft, Apple, and Amazon. Instead of the market carefully rewarding the most deserving businesses based on profit, this passive boom acts like a gigantic momentum machine. It inflates the biggest stocks for no other reason than, well, they're already the biggest. Now, to really understand how this giant machine actually functions without breaking, we have to look at the mechanics running the show. Enter the authorized participants, or APs. See, when you buy a share of an ETF, you are not actually buying the underlying stocks directly. You're relying on a highly specialized middleman. These APs are the ones doing the heavy lifting in the primary market. They are massive, heavily leveraged broker-dealers, and by institutional design, they are literally the only players allowed to trade directly with the ETF sponsor. Everyone else, you, me, regular retail brokers, we're all stuck trading on the secondary market. If an ETF needs to create brand new shares to meet surging demand or destroy them during a massive sell-off, the AP is the only one holding the keys to do it. And here is where it gets really clever. APs use a brilliant three-step arbitrage loop to constantly keep the ETF's price strictly aligned with its actual underlying value. Let's say an ETF is trading at a premium, meaning it's weirdly more expensive than the actual bonds it holds. The AP spots the gap. That's step one. Step two, they dive into the market and buy up those cheaper underlying bonds. Step three, they hand those bonds over to the ETF issuer, and in return, they get shiny new ETF shares, which they instantly sell at a profit. This little loop floods the market with new ETF shares, which naturally pushes the inflated price right back down to reality. But things are definitely not perfect. In fact, there's a major trap hiding in here when we mix instant trading with slow-moving assets. You see, underlying assets, like corporate bonds, for example, often trade incredibly slowly in opaque, over-the-counter markets. But the ETF itself, it trades instantly on an exchange. This creates a massive conflict of interest for our APs. They are constantly torn between two jobs. Job one, act as an arbitrager, fixing the ETF prices like we just outlined. Job two, act as a bond dealer, desperately trying to manage their own incredibly risky warehouse of corporate bonds. Sometimes, fixing the ETF price means the AP has to swallow a bunch of illiquid, toxic bonds they really don't want. Their role as a market mechanic directly clashes with their instinct to survive as a dealer. And when their own inventory gets too crazy, APs basically throw their hands up. They stop fixing the ETF prices and start trading purely to dump assets and save themselves. If an AP is holding way too many bonds, even if the math says they should be buying the ETF to fix a price discrepancy, they might just do the exact opposite. They'll bundle up their unwanted bonds, create new ETF shares, and dump them into the market just to get the risk off their own books. They're optimizing for their own survival, not for keeping the ETF price accurate. And here's the kicker. APs have absolutely zero legal obligation to perform this arbitrage. If the market gets too scary, they can, and will, just walk away. So what happens when you take that shaky plumbing and dump trillions of dollars of passive money into it? You get severely overcrowded trades. This combination actually warps the pricing of the entire stock market. Even the Federal Reserve has pointed out that pouring endless cash into these overcrowded index funds artificially alters market behavior. When massive pension funds and everyday retail investors are all piling into the exact same S&P 500 ETFs, the stocks inside that index start moving as a single blob, totally detached from their actual individual business fundamentals. The Fed noted that if these distortions get bad enough over time, it actually creates a massive, profitable opening for active managers to swoop in and exploit the blind, automated trading of the passive crowd. Now, if basic ETFs have these kinds of hidden mechanical risks, you have to wonder, what on earth happens at the extreme edges of the market? Welcome to the wild world of leveraged and inverse ETFs. This is where the whole passive label becomes a total illusion. These are geared funds that use complex derivatives to artificially multiply daily market moves. A leveraged ETF doesn't just quietly track the market, it actively tries to double or triple its daily return. An inverse ETF tries to do the exact opposite. And to pull this off, they aren't just holding normal stocks. They are loaded to the brim with complex derivatives, swaps, and futures contracts. To make that extreme leverage work, these funds have to undergo a forced, rules-based rebalancing every single day. And this acts like a blind momentum machine that seriously amplifies overall market volatility. Think about it. If the market surges, a leveraged ETF's assets swell up, and they are mechanically forced to go out and buy more exposure to keep their leverage ratio steady. If the market tanks, they are forced to sell. They literally have no choice but to buy high and sell low at the end of every trading day. And they do this completely regardless of whether actual investors are putting money into the fund or taking it out. And because Wall Street is Wall Street, these massive forced rebalancing trades are highly predictable, which makes them incredibly easy for opportunistic traders to front run. Everyone knows exactly when and roughly how much these leveraged funds are going to have to trade right before the closing bell. It's like playing poker with your cards facing outward. Other players just jump ahead of the trades, which distorts prices even further and throws a massive wrench into the system. In fact, regulators have warned that as these geared funds grow, their forced trading could severely amplify daily price swings across the entire stock market. Let's pull all of this together to look at what this really means for the stability of our broader financial system. We've journeyed from simple index funds to conflicted APs juggling bonds, all the way down to the forced daily trading of leveraged derivatives. The big takeaway here? Passive investing relies on highly complex mechanics, extremely vulnerable intermediaries, and blind, forced trades. Researchers are seriously warning that all of this combined poses a very real threat to financial stability. The instant liquidity you feel when you trade an ETF is often just an illusion, propped up by the risky liquidity transformation happening backstage. When times are good, authorized participants happily build the bridge. But in a severe market panic, those same intermediaries might just close up shop, right when the market needs them the most.
So, I want to leave you with this final thought. When the next big market shock hits, how well do you really understand the unseen plumbing holding your portfolio together? The massive shift to passive index funds has absolutely democratized investing, but it has also secretly wired our financial system to automated, rules-based trading run by middlemen with huge conflicts of interest. Next time you look at your so-called passive portfolio, don't forget about the wildly active gears spinning furiously right underneath.
This has been Expanding Frontiers, a Pearl Quest podcast. Stay open to what reveals itself. Until next time.